In recent years, we have witnessed a phenomenon that revolutionized the way many see money: cryptocurrencies. Promises of instant wealth, stories of investors who became millionaires overnight, and a futuristic technology that seemed destined to dominate the financial world. The result? A wave of enthusiasm and, for many, a roller coaster of emotions and losses. But here's a question that few dare to ask. Are cryptocurrencies really the best option for building long-term wealth? Because while some are busy dreaming about the next Bitcoin, there are others who, quietly, are using much more stable, proven, and profitable methods to multiply their money: real estate investment and the stock market. In this video, we're going to put these three options head-to-head: cryptocurrencies, real estate, and the stock market. What do they have in common? What makes them different? And, above all, why could the last two be so much better than cryptocurrencies for securing your financial future? This is not an attack on crypto. It is an unbiased comparison based on real numbers, facts, and strategies from the world's best investors. Are you ready to find out if you're betting in the wrong place? If anything defines cryptocurrencies, it is their extreme volatility. These digital currencies, while innovative and promising, have proven to be as unpredictable as the weather in spring. One day Bitcoin can be worth $60,000, and the next, it can fall below $30,000, wiping out the savings of those who were not prepared for this financial roller coaster. Why is this happening? Mainly due to three key factors: its speculative nature, dependence on public opinion, and lack of regulation. First, cryptocurrencies operate in a market where emotions and rumors carry more weight than economic fundamentals. A statement from an influential figure like Elon Musk or a change in a country's policies can trigger massive movements in a matter of minutes. Second, their value depends almost exclusively on what others are willing to pay for them, which creates speculative bubbles that often end in sharp corrections. Finally, the lack of regulation adds an element of uncertainty, exposing investors to risks such as fraud, hacks, and unexpected liquidations. In contrast, both real estate investing and the stock market offer stability that allows investors to plan for the long term with greater confidence. Real estate, for example, is a tangible asset whose value typically remains the same or increases over time due to constant housing demand and urban growth. Real estate investment not only provides stability, but also generates passive income through rental income. A property in a strategic location can offer an annual return of 6% to 10% in rental income, in addition to the appreciation in the value of the property. Let's consider a practical example. Someone invests $200,000 in a property and rents it out for $1,500 a month. This equates to $18,000 annually, which represents a 9% return on the initial investment, not counting the increase in the value of the property over time. In addition, real estate allows for leverage, i.e. buying larger assets using loans, which amplifies long-term gains. S&P 500, meanwhile, have demonstrated sustained growth for decades. Since 1997, this index has accumulated returns of over 700%, making it a solid choice for those looking to build long-term wealth. Reason 2: diversification and risk reduction. One of the most valuable lessons in the world of investing is this: don't put all your eggs in one basket. This principle is key to protecting your capital in the face of uncertainty. When it comes to cryptocurrencies, many investors often make the mistake of betting all their money on a single asset, such as Bitcoin or Ethereum. While these names are the most recognizable, their extreme volatility can make them dangerous. For example, a single negative event, such as a government regulation or a market crash, can wipe out a large portion of their value in a matter of hours. On the other hand, both the stock market and the real estate market offer significant opportunities for diversification. In the stock market, investors can opt for index funds that replicate the performance of indices, such as the S&P 500, or for ETFs that cover multiple economic sectors, from technology to health. Even individual stocks allow for diversification by choosing companies from different industries and geographies. In the real estate sector, diversification can be achieved by acquiring different types of properties: residential, commercial, or even land. Furthermore, thanks to REITs, or real estate investment trusts, anyone can invest in real estate without having to buy properties directly. These funds allow exposure to a diversified portfolio of real estate assets with lower initial cost and fewer administrative complications. Another clear advantage of real estate over cryptocurrencies is its tangible nature. A property will always have an inherent value because people will always need a place to live, work, or set up a business. This intrinsic value provides a level of security that simply doesn't exist in cryptocurrencies. For example, a building or a house can generate a steady income through rents, even in times of economic crisis. We could then say that real estate tends to be more stable simply because it is backed by a fundamental need. Cryptocurrencies, on the other hand, lack this physical or functional backing. Their value depends solely on supply and demand in a speculative market, making them extremely volatile. While some argue that the technology behind cryptocurrencies, such as blockchain, has potential value, this does not directly translate into the financial security that investors seek. Therefore, diversifying into more stable assets backed by tangible value, such as the stock market and real estate, is a much more reliable strategy to reduce risks and ensure long-term capital preservation. If you found today's video useful, don't forget to give it a like and subscribe to the channel to stay up to date with our upcoming content. Let's move on. Reason 3. Regulation and protection. The level of regulation and investment protection is another crucial factor that investors must consider before placing their money in any asset. The question we must answer is, how safe is it to invest our capital in digital currencies like Bitcoin? The appeal of cryptocurrencies lies in their decentralization and the freedom they offer users. However, this feature is also their greatest vulnerability. In a market where there are no intermediaries or central regulators, the risks are significantly higher. Hacks, frauds, and exchange collapses have been recurring events in the cryptocurrency world. Examples such as the Mt. hack in 2014, which resulted in the loss of over 850,000 bitcoins, or the collapse of FTX, which left thousands of investors without their funds, show the fragility of the crypto ecosystem. On the other hand, the stock market is a highly regulated market by entities such as the SEC in the United States. These institutions oversee the operations, transactions, and information that publicly traded companies, such as Apple or Google, must disclose to their investors. In addition, stockbrokers are required to comply with strict legal standards. As a result, stock investors have greater protection against fraud and market manipulation. In the case of real estate, the buying and selling process is supported by legal contracts and established procedures, which considerably reduces the risks of fraud. In addition, being physical assets, properties are more difficult to steal or manipulate, and their value does not depend solely on market perception. Despite recent advances, cryptocurrencies continue to operate in an uncertain regulatory environment. Some governments have begun to establish legal frameworks for trading and holding cryptocurrencies, but these regulations vary widely between countries. For example, while countries such as El Salvador have adopted cryptocurrencies as legal tender, in others, such as China, Bitcoin, and other cryptocurrencies have been banned for disrupting the economic and financial order. This lack of consensus and standardization leaves investors in a vulnerable position. Without clear regulation, risks range from the inability to recover lost funds to uncertainty about tax obligations associated with cryptocurrency profits. Additionally, investors may find themselves in situations where exchanges or trading platforms disappear without warning, taking users' money with them. In contrast, both publicly traded stocks and real estate have a more robust legal backing. Investors in stocks have access to security measures such as insurance against broker bankruptcy and access to legal mechanisms in case of disputes. In real estate, the purchasing processes are accompanied by detailed documentation and legal controls that protect both the buyer and the seller. In conclusion, while cryptocurrencies represent an exciting and innovative sector, the lack of regulation and adequate protection makes them a riskier option compared to more traditional investments such as the stock market and real estate. The latter not only offer legal certainty, but also greater peace of mind for those looking to protect their capital. Reason 4. Control and predictability. One of the biggest advantages offered by traditional investments, such as real estate and the stock market, is the level of control and predictability they provide to the investor. When you invest in real estate, you have direct control over your asset. You can decide whether you want to rent, renovate, or sell the property based on your financial goals. This tangible control allows investors to implement customized strategies to maximize their returns. For example, a homeowner can improve a home, increasing its value and rental price, leading to consistent income and capital appreciation. In the stock market, although investors do not have direct control over the companies in which they invest, they do have analytical tools to make informed decisions. Historical data, financial reports, and market analysis allow them to predict, with a certain degree of accuracy, how stocks might behave in the long term. In addition, strategies such as dividend investing or index funds offer greater predictability in returns. In contrast, cryptocurrencies are subject to extreme volatility that is completely beyond the control of the investor. Events such as a tweet from a public figure, a regulatory change in a major country, or even a rumor can trigger dizzying rises or falls. In this environment, it is difficult to plan with certainty or execute long-term strategies. Reason 5. Accessibility and education. Investing in cryptocurrencies may seem appealing because of the stories of those who have become millionaires quickly, but the reality is that it requires a fairly significant level of knowledge. Concepts such as blockchain, private keys, wallets, and exchanges can be overwhelming for a beginner. This technical complexity creates a significant barrier to entry, leaving out many people who lack the time or resources to properly educate themselves in this field. Meanwhile, the stock market and real estate offer much greater accessibility, especially for those who are taking their first steps into the world of investing. Financial education in these fields is widely available and accessible to everyone. From books like The Intelligent Investor from Benjamin Graham, who is considered a Bible for those starting out in the stock market, to podcasts and YouTube channels explaining how to evaluate real estate, educational tools are plentiful. This makes them more inclusive and less intimidating alternatives to cryptocurrencies, allowing more people to educate themselves and invest in an informed way to build their long-term wealth. In conclusion, while cryptocurrencies may be cutting-edge and even more promising, they do not compare to the security and stability offered by real estate and the stock market. The latter are more reliable options for those looking to build wealth steadily and with fewer surprises. Betting on what is proven and diversifying will always be a smarter strategy to grow financially without risking everything in such an uncertain market. Are you planning to invest in real estate or the stock market? Would you like us to analyze some assets in another video? We'll read your comments. If you like today's content, remember to give it a like and subscribe to the channel so you don't miss the next video. See you later.